Equity Market Update, March 2023. Indian equities ended FY23 flat on year-on-year basis, driven by tug-of-war between two sets of conflicting forces. The key factors supporting market were relative strong domestic growth, robust corporate earnings, optimistic growth outlook, large inflows into domestic institutional investors, etc. However, accelerated monetary tightening by major central banks, volatility in commodity prices, large FPI selling, etc. drove the equities lower. Mid-cap performed largely in line with large cap, while small caps underperformed. Capital goods, FMCG, auto and banking were the key outperforming sectors, while IT, metal, power, healthcare and oil and gas underperformed. Performance of major global equity indices was mixed, with European equities performing better than US and Asian markets. FPI sold net equities worth $6.3 billion in FY23 as compared to net selling of $17.1 billion in the year prior. However, the DII flows more than offset the FPI selling. DII bought net equity of $32.2 billion during the year, vis-a-vis net buying of $29.5 billion in FY22. Domestic mutual funds registered a net inflow of INR 2.1 trillion in 11 months FY23 as compared to INR 2.2 trillion during the same period last year. The broad-based rally during the past year narrowed the valuation divergence significantly. Outlook: as on 31st March 2023, Nifty 50 was trading around 18.9x FY24E and 16.3x FY25E price to earnings ratio. While the valuation multiples have moderated from recent peak but are still elevated vis-a-vis its historical average, the ratio of India's market cap to GDP based on CY23E GDP stood at approximately 85% of its peak. The gap between 10-year GSEC and 1-year forward Nifty 50 earning yield has also narrowed, but still higher than its long-term average. Thus, the market valuations based on historical averages appear to be slightly high. One should view the same in the context of structurally attractive nominal GDP growth, robust economic recovery, healthy corporate earnings outlook, and strong delivered corporate balance sheets. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in the near term. Outlook for the market is likely to be driven by expected growth in nominal GDP and corporate earnings growth. Optimistic domestic growth outlook, steady corporate profitability, growth supportive policies, etc. bode well for the economy and equity markets over the medium to long term. Accelerated monetary policy tightening, sharp slowdown in global growth, persistent inflation, slowdown in earnings growth, delay in recovery in rural sector, etc. are likely to be key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.